Did anybody here flying in New York and get hit with those winds that were coming into the airport? It was like, we saw an article that were coming down, there was like 30 passengers were bloodied landing, and my thought is that they were all short sellers, but it was, So, first, welcome. I think it's to the last talk of the night, talking about options, and I always like to get a sense of just kind of everybody. I've met, know some of you guys and met some of you. How many people in here have been trading for like less than a year? Just out of curiosity. Okay, over here. And how many people here have like never really traded options before? A couple? Okay, so we'll try to save you a little pain and suffering along the way. And then also just kind of introduce some concepts if you guys have been doing this for a little while, just some of the things at least that I've been looking at. And in a market right now where what's interesting right now is if you look at the facts, or if you're looking at anything that I would just call the fundamentals, you'll notice if you read things like that, it'll say, wow, earnings have been declining year over year in 8 out of 11 sectors, yet the stock market's going higher. So how many people think here right now in this current environment that fundamentals are very important in your decision-making process? Okay, a couple people still admit that. That's awesome. Okay. Half joking, but the thing to understand is that in this environment, and I actually think for the foreseeable future, is that the two most important things that are going to impact the markets are just going to be the stance of the Fed and where the liquidity is. And that's pretty much it. And the reason I say that, and I'm a kind of a closet bear, but I also like to, the saying is that when you're dancing with the market, it's best to let the market lead. You're not going to be able to force the market to do what you want. So if you've got a mindset where the idea of gold bullets, spam, and bunkers is first and foremost in your mind, you're going to find plenty of news out there to back that, right? But on the other hand, if you're like, well, how about I don't have an opinion and I have no idea what's going to happen next, and then you just kind of go with the flow, then you can flow with the market that's going higher, and conversely as it's going lower, because all of the news and all the stuff out there, it really doesn't have as much of an impact as we all think it does. So first, welcome. So one question here is, and again, this is kind of like you can think of it as a safe space. We're all traders here. We support each other. How many people here are currently struggling with their trading? Okay, so we got 2 honest people. So the thing with this, and what I wanted to kind of go through some things through today, are just kind of showing you some tools in the market that kind of help. I don't know if it's take away the struggle is the right word, but there's so many things that in the market that you actually don't need to pay attention to. And if you stop paying attention to it, your results will be better. And so it's kind of going through that and then just talking about some specific trades that you can do along those lines. I remember this is a long story short, but it took me about 8 years to get to a point where I was consistent trading, and I blew up 3 accounts, and I don't know why. 3 is kind of the magic number. I'll talk to people that are like, oh yeah, I blew up 3 too. And it's like, okay, great. And yeah, how many at? 2.
You said 3-2.
Oh, 32? Yeah, 302. Yeah, no, that would be, no, my wife would have left me by then. It was, I tell this story I've got a book out called Mastering the Trade. I tell this story in detail there, but the short version is that I had reached a point where I was working full time. I had built up about a $150,000 account. I was getting steady income out of it every week, and it was working great, and I was about to quit my job. I got relocated in the corporate world up to Minnesota in January, and my fiance at the time, who grew up in Austin, Texas, had never seen snow. So we get there, and I go to work. Both of our cars died. They were from Texas. The cars didn't understand what to do in Minnesota. And so she was kind of like locked in this apartment underground for a month. And she started to go a little nuts. And I came home and she was resanding the walls for the second time. And I was like, all right. So she said, look, I love you and all, but we need to get a house with like a heated garage or I'm out of here. I was like, okay, I appreciate the additional pressure you're putting on me here. So, so we found a house. It needed a $30,000 down payment, and I was like, okay. And I showed them my trading statement. That's where the funds would come from. Great. So a week before this whole thing happened, I was sitting there one night, And I just thought, you know what, if I've got my $150,000 trading account, I'm in a groove, the money I've been wiring out, I've been putting it into like rare coins, they weren't really liquid, I couldn't go run out and sell them, the bid ask you could drive a Mack truck through. And I just thought, psychologically, if I now have $120,000 in that account after I wire out the 30, I think that's going to mess me up a little bit. Wouldn't it be better just to have a couple of aggressive trades, build up my account to 180, wire out the 30, right? And I've got my trading balance. And I was like, man, this is probably the best idea I've ever had. And so the next morning, I'm looking at the charts, and this is like in the mid-90s, and I was trading OEX options, and as I'm looking at the charts, there's like a downtrend line, we're coming back up to it, and I was like, oh yeah, I'm gonna buy some puts, this will be great. And so I put half my account into these OEX puts. And I remember because the transaction took place at $8 or something like that. And towards the end of the day, the markets kind of popped up again, and I thought, man, this is really the best opportunity I've ever had in my life. And so I went ahead and put the rest of my account and bought another 100 contracts. The market actually went down into the close, and I was up $12,000 by the close. And so in the morning, I was just like, wow, this is going to be great. I just get a little bit of a gap down, bada boom, bada bing. So the next morning, I wake up. I'm super excited. I turn on CNBC, and you see the little Dow, the futures before the market opened, and it said Dow futures up 180. I was like, and I turned off the remote because that wasn't right. Turned it back on, and yes, they were up 180. So at this point, I'd been trading long enough to know that obviously this trade wasn't going to work, but typically markets, when they gap up, they retrace half the gap. I'll be able to get out. I'd lose about 20 grand, live and learn. I gave it a shot. Well, what happened was that the market gapped up, traded flat all afternoon, and rallied into the close. I didn't have a plan for that, so I just watched it. And then the next morning, it gapped up, traded sideways, rallied into the close. And it did that for 2 more days. And suddenly, I actually don't remember this time at all. It was like the whole deer in the headlights kind of a phase. So I caught, my broker, I'm like, you need to close out my positions. I got to buy a damn house tomorrow. And so he did, and my $150,000 balance was now $8,300. Exactly. So the first thing I did was made a promise to myself that I would never tell my wife what happened. So, and she actually didn't find out. That's her calling me now. She actually didn't find out until I was talking about it at a talk like this 10 years later. And everybody in the audience was like, God, you're so supportive. And she's just smoldering. It was like, what else have you not told me? So I didn't tell her, but I did max out my credit cards and I was able to buy the house. So that's another story. But after that, this whole please help thing was that I finally realized at that point is that I really loved trading. I could make money trading, but why would I reach these moments where everything just kind of imploded like that? Because that obviously didn't give me confidence to be able to do that consistently, to be able to do that, with a wife and children and things like that, and really not put everybody through a lot of stress. And I went through about a 6-month period where if you guys are familiar with Mark Douglas, Trading in the Zone, Disciplined Trader, if you're a newer trader, I highly, highly, highly recommend you read those books. It talks all about the mental state of trading. It's kind of like these are drugs, this is your brain on drugs, or this is your brain on drugs. It's the same thing when you're trading. And you've got to be able to understand the mindset that naturally takes over when you're trading. And if you don't understand that, you're basically a slave to the markets. Okay? And so through all that, what I learned was to stop trying to make money and instead to just focus on a handful of setups. You focus on the setups, you focus on the risk, and the profits take care of themselves. And anytime you're fearful, when you're going into a trade or anything like that, all you got to do is switch from the fear of the unknown to just focus on the risk of the unknown. Nobody knows what's going to happen next exactly in the markets, but you can control the risk, which is why I love options so much. So all that being said, what I'm going to talk about today is strategies specifically more for smaller accounts, geared like less than $25,000. If you have more than that, you can still use it. There's a lot of things I typically talk about that you can do when you're using portfolio margin. Okay, you can do a lot of great straddles and strangles and all this kind of stuff, which you actually cannot do in a small account. A lot of times you just don't have the margin to do it. So what I did this year, and I trade a couple of different accounts, but what I did at the beginning of this year is I set up a small account, like with $6,000, just to kind of show what could be done in that type of a situation. I don't know if you guys can see that okay, but so the account started at $5,900 at the end of January. It's just under $12,000, so up about 100% in January. End of February was $19,800, so at that point it had tripled. And then this morning, with the move up, it's now at $23,000. I guess that's so almost like a quadruple. So, and I just show you this to show that, hey, this is, just kind of doing this not like with some theories or back testing. It's just kind of what you really do in this kind of environment. And the important thing about this, and I think this is kind of the most important slide here in this whole process, is that instead of focusing on making money, the idea here, and by the way, we will get to some trade setups here in a minute, is to focus on the process. And the only process that you should be concerned about, and regardless of what kind of account size you're trading, is this. You want to simply, your only goal as a trader here, it's not to be right, it's not to understand what's going to happen next, it's not going to predict what Powell's going to say next. It is to, your number one goal is to say, okay, here's my starting point for my net liquidating value, which is the value of your account. Your only goal is to make sure that it goes from the lower left of your screen to the upper right. Okay, I should probably face this way. You have no other goal besides that. And what's nice about that is once you realize that, it takes off all the pressure from what's going on in your current position. Okay, and if you look at this, what will happen as you're doing this is, you're going to go up, your account's going to make a new high, and then there's going to be a pullback. Well, I have a trailing stop loss in my P&L, and anytime I have a 10% pullback in my P&L, I go flat because something's not happening here. And I can go flat, I take 24 hours off, and then I can redo that. And you'll notice here, when there's a pullback in equity, just go flat for 24 hours, get reinvigorated. If you like those positions, that's okay. Reentry is only a commission away. But what's happening now is you're not getting tied into any stories about hanging on to a losing trade in the hopes that it comes back, because your brain is actually malfunctioning at that point. You're putting hopes and dreams onto the market that don't exist, and the market doesn't even know you exist and doesn't care about you. So it's a way to manage, instead of worrying about what your position is doing, just manage your P&L curve. So the first part of this we want to talk about, and obviously right now the market's trending higher, but there's going to be some times when the market is trending lower, and that's fine. It really doesn't matter if the markets go up or down. You just want to have actionable signals that you can take. If you're trading an account that you want to grow, you've got to know that there are certain moments in time when you really have got to put some hedges on, okay? Meaning that you've got some positions that are long, but there's some certain things happening in the markets that actually increase the risk exponentially of at least a pullback, if not a rollover. And if you're not able to identify those, they're always going to be a surprise, okay? And you don't really need that. So this is just an example of how like a portfolio would be structured where, all right, on this day, the S&Ps were down 25 points, yet I'm still up $600, right? So I've got a long in Chipotle's, it's not working out, but I've got a hedge in the spiders where I bought some puts, that's great. I've got a hedge in some VIX calls, and that's great. And there's specific moments like that I want to show you where instead of sitting there and hoping that the market's going to continue going higher, actually identify that this is a moment when there's probably going to be a pullback. And instead of just sitting through it and sucking it up and being victim to something that could turn more aggressive than you had planned for, hedging yourself, all right? And it's easy to do with options. So what I do is, this is just a daily chart. Those are Bollinger Bands. They're available on any platform. This happens to be Thinkorswim. One of the tools that I like to look on it is called a squeeze. This is something that we created. It's also on the Thinkorswim platform. When there's a squeeze like this, so there's two signals here we're looking at. When there's a squeeze on the VIX, that's one of the only times that you'll see that it has the opportunity to explode higher like this, okay? You'll notice there's one right now. So when you see something like this, you have to have hedges on because you could get this crazy move out of the blue like that. The second thing is, and by the way, I'll give you guys a copy of these slides afterwards. I'll show you how to get those. The second thing is, and I was going to try to zoom in on this, but it's a PowerPoint slide, right? Is that anytime the VIX touches that lower Bollinger Band, if it comes down and gives it a little bit of a kiss, and if you guys are in the back, there are some seats here and there up here if you guys would like to come up, or you can sit Indian style right here on the floor. Anytime the VIX touches the lower Bollinger Band, okay, it really has nowhere to pop up and either test that little midpoint there or the upper band as it did recently. So The other thing I like to do with this too is the spiders. Same chart, and it's the spiders, and it's the same thing. Guess what? If the spiders come up to that upper band, you got to work it off by coming back to the mid band, or work it off by coming times when you want to have hedges in place.
Your mic is out.
Is it out?
It's fading in.
What you guys? What are you guys doing back there? I'm looking at the audio. Do you want me to use this one? It seems like it's kind of working, right?
Hello.
Okay. So in options trading, by default, if there's a signal that I like, I will, and if I'm buying a call or buying a put, I'm going to buy an in-the-money option, something that'll kind of mimic the stock movement as much as possible. However, in this situation, I deliberately buy those out-of-the-money Delta 30 options, okay, 30 days out, or sometimes even 10 days out. But you'll notice here you can buy them pretty cheap. I mean, I'm buying them for 34 cents, selling them for 85 cents, right? This is something where that's kind of what a hedge looks like in terms of if it doesn't work, that's okay. You don't lose a lot, and obviously you're going to make money on your longs. But then if the market does have a nasty pullback, you're kind of covered. That's part of how you manage that steady growing net liquidating value. So you'll notice this was, Wednesday or Thursday of last week, one of my biggest losers this year in this account was John Deere, and it was down $1,750, but I wasn't worried about it because my spider puts were up $1,732. You'll notice here that my net liquidating value during that time stayed flat. Okay, that's the idea of a hedge. So you don't have to sit there and you don't have to wake up in the morning and it's like, oh my God, the S&Ps are down 30, I'm going to get killed, right? Your portfolio can be structured in such a way that that's not a big deal. So if the market is up and every position you have is up, that's actually not good because that just means you're just hoping and praying that the market continues to go higher. So in this case, hey, an uptrend, the trend is your friend until it ends. But when you get those extreme moves like that on the VIX, okay, and on the spiders, great, put up a little hedge, and I'll show you exactly the ratio that I use, and then that way you can at least sleep better at night. So when to hedge. When the spiders hit the upper Bollinger Bands by 30-day out Delta 30 puts, and then vice versa. On Friday morning, the spiders gap down, they hit that lower band, awesome, you're going to rotate out and buy those calls. So I'm always doing that with the spiders when we get into those positions. If you're familiar with the VIX or any volatility products, you can do the same thing there. And you can use UVXY or any of the ones that you want. I personally like the VIX. On the VIX, if you're a little bit more advanced options trader, you'll know that the call side of the VIX, the premium, of course, is extremely high. So I always like to do a call debit spread. If the VIX is at 15, I'll buy the at-the-money 15, sell the 20. Typically, you can create a debit spread where you're risking 1 to make 3. And then if the market pops up, or the market rolls over like it did, the VIX pops up, and you can make some money that way as well. So when stocks are in an uptrend, and I define an uptrend basically is it trading above its 21-period exponential moving average, and we hit those specific levels on the Bollinger Bands, okay, what I switch my portfolio to is 50% cash, 35% long positions, and 15% hedges. Okay, there's another reason that I go to 15% cash, and if you guys, the market has a tendency, and if you go back and look at this, you'll be appalled if you haven't noticed it before, but the market has a tendency in the 2 mid-Fridays of the month where it'll close at its highs on Friday and then gap down and sell off on Monday. And if you've got a small account, and the main thing you're trying to do is manage your net liquidating value, guess what? Get out of those positions on Friday and you can reestablish them on that Monday. So basically what happens here is you typically have a strong trend, whatever the market's trending, strong trend the first 10 days of the month, kind of a middling back and forth the middle 10 days of the month, and then going back to a strong trend toward the end of the month. Great. Position your portfolio accordingly. Be kind of locked and loaded at the beginning of the month to capitalize on the trend. In the middle of it, get your hedges on, raise cash, and then get back in towards the end of the month. And this happens over and over and over again. I think this should have been at the beginning, so we'll just keep going. I have, and I'm not done yet, by the way. That's a book that I have out. It's Mastering the Trade. This story is kind of funny. So I think Have you guys ever read a newsletter and it was written so well that you were convinced that the end of the world was going to be next week? Yes. Right? Okay, so in 2006, 2007, I came across some doom and gloom newsletters. I was convinced that the world was going to go to shit. Up, quarter in the jar. Let's see. And I'm trying to find something. I'll have to find something for that. So what I did is that the newsletter that I wrote, or that I read, convinced me to buy gold and silver. That's fine. I liked collecting coins and stuff like that too. So over the course of 4 years, I ended up getting 1,562 pounds of silver, which is about 25,000 ounces, as well as various gold coins and stuff like that. So the 2008 financial crisis came, as expected. Silver and gold went up after some gyrations and stuff like that. And then I realized, you know what? It's probably time to sell. We bought the silver at $7 to $10. Now it's around $35. Let's cash this in. So to sell it took 3 days to box it up, and 7 days to get the money. And I'm driving around. Of course, I'm driving around in my car with all this silver, a gun that I don't know how to use. Hoping that this is not the day that somebody's going to pick to rob me. But what was interesting about this whole process is during this financial crisis, I remember going to Walmart one day, and guess what? People are still going there and they're buying toilet paper, and they're not using silver, okay, to pay for it. They're actually using fiat worthless currency. So I think the whole idea of this is just an example of just be careful when you get really, really wrapped into one idea. Okay, this is called confirmation bias. If you have an inner belief about something like that, like the end of the world, then you're automatically going to filter out anything that's contrary to that and get really married to anything like that. And this is an example of how that happened to me. It turned out good. I mean, it was a good investment, but I always try to take things with a grain of salt. I like to balance extreme negative news with extreme positive news, and the truth generally is somewhere in the middle. Unless it's on social media, and then it's all fake. Let's see. Okay, so we did that. So, and these days I'm trying to do my trading so I can, still watch my kids grow up. I used to do a lot more, going around speaking and stuff like that too. So that's my trade setup. Let's get back to the setups. Great. Okay, so what's been interesting is after I was talking a little bit earlier about the story with the Minnesota house. That was my third and last account that went into the toilet. And since then, over time, is grown accounts, been trading larger accounts. But what was interesting, and kind of what drove me to set up a smaller account this year too, is that what was interesting in trading larger portfolio margin-based accounts, I actually learned things. It's like, wow, it would be great to do something like this in a small account. Let's go through and kind of look at that. So one of the things, we talked about the spider puts, or the spider and the VIX trades. So it's one of my favorite trades to look at. I'm always, want to know kind of where they are in relation to the daily Bollinger Bands. So the second thing here is understanding what really moves markets. If you guys remember at the beginning of this, we were talking about the idea of how important are fundamentals, how important is news to the price of a stock. Well, a couple weeks ago, Zion Williamson, one of the best, I think probably the best college basketball player that's out there, on live TV, slipped on a pair of Nike shoes that kind of exploded on him and twisted his knee. All right, the next morning, the headlines are Nike's stock market value plunges by $1.1 billion after basketball star Zion Williamson's shoe breaks, okay? Twitter exploded, and these are just random screenshots. I don't know these people. Short Nike tomorrow, okay? King of Trades said at this moment in time when Nike was rolling over, Nike weak and heading lower. All right, and then at the end of the day, Walnuts said, I don't understand how Nike was able to shake that off and rally. Okay, that's the whole idea there. And so if you look at what happened that morning, Nike gapped down, okay, traded back and forth. This is kind of where the tweet came out, looks like it's heading lower, and then closed positive on the day by 81 cents and closed exactly right here at this big red line. Well, on Thinkorswim, all that is the monthly volume profile level, okay? That's called the point of control. And when we go back to understand what's really moving stocks these days and what's really moving the market, it's not fundamentals. Again, over time, this is stuff that'll play out. But today it's all about what is the Fed chairman talking about? Is he hawkish or is he dovish? When we had that big puke down in December, that was when Powell didn't understand how to talk to reporters. Then he learned how to talk to reporters, and we came all the way back up. It's like that move didn't even need to happen had he known how to explain himself. So when I say that markets move based on liquidity, this is essentially telling you where all the institutional transactions are taking place, and the markets will gravitate towards that level. So here was a day on Nike. It had horrible news out. Everybody was shorting the stock at the open, and yet it rallied. Okay. Again, it's the news. The news typically is an opportunity to do the opposite of what the headline is. So just kind of keep that in mind. Boeing is another good example. Today it traded, I think, as low as $360. It closed at $400. All right, it was still down on the day, but that opening move down, it started working its way back up towards that weekly and monthly point of control. All right, so just, if you kind of keep that in mind, what will happen is that when you look at the news, first of all, you're going to look at it a lot more skeptically, which you should. And then secondly, you're going to look at it, where is the trade opportunity here? So on stuff like this, what I like is that you have a big gap down like that. Again, same thing. You can buy some cheap out of the money calls. And I always like to position size it so that I call it a who cares trade, okay? If you have, say, a smaller account, $20,000, is it okay to risk $200 on a trade like that? Yeah, you know what? If that goes to zero, it's not the end of the world. Buy some out of the money calls, and if it does rip higher and you're getting a 5 or 10x return on that, then it's worthwhile. You can do those kinds of trades with this tool. Also, if you're a little bit more advanced and you understand butterflies, you can set up butterflies right at those levels, so you're taking much less risk, and if it comes back up there, you know, boom. So it's something, again, I found that, you know, I do like to look at a lot of things like the trends and the moving averages and things like that, but this is the stuff that's actually driving the market movement out there, and you just want to understand what it is. This was just a note from, I always call him Drunken Miller, but it's Druckenmiller. But it just talks about, too, is that, you know, he said earnings don't move the overall markets, it's the Federal Reserve Board, okay? Essentially, are they doing quantitative easing with the combination of lowering rates and expanding the balance sheet, or are they doing quantitative tightening by raising rates and reducing the balance sheet? Well, what happened this time around, it's the first time it's happened in the history of central banks, is that Powell looked at the stock market falling, and when it hit 2,400, he essentially realized that, gosh, if these asset prices start to fall, it's going to ruin the economy. Before then, what would happen is they would continue raising rates until wage inflation subsided, okay? Right now, there are 7 million job openings out there in the United States. Wage inflation continues to go higher, but he is now, for the first time ever, ignoring that because he wants to save asset prices. So think of that if you want to really fight what's going on out there in the markets. It's almost kind of like if you have, you know, if you're, you've got an aunt or an uncle that's a billionaire, and you just got out of college, and you're trying to start businesses, and you have failure after failure after failure, but they just keep funding you. Here's another 100 grand, here's another 100 grand, here's another 100 grand. That's kind of the situation that we're in right now. I'm not saying it's going to end well, but I'm just saying be aware of it and don't fight it. So basically here you want to trade to where the liquidity is located. So keep an eye on that monthly point of control. And again, that's just a free indicator that's on a lot of platforms. On Thinkorswim, it's called Volume Profile. And remember that stocks move on liquidity. After that initial reaction on news, they're going back to where the liquidity is, and that is how you track where that is. Okay, so the other third thing I want to introduce, and again, this is it's a free indicator on most platforms, it's called VWAP. Okay, there's a couple things that you want to understand about VWAP besides the weird name. It's just called the volume weighted average price. Now, the reason this is important is that a lot of computer programs out there and algorithms trade on this first. Secondly, all of the stock buybacks that happen out there, the billions and billions and billions of dollars of stock buybacks, all happen at the weekly VWAP level, okay? So what you're looking for on a long trade here is that you want to see on this chart here, the monthly VWAP is purple, okay? And the weekly VWAP is white. So what you want to see, and obviously you can make the colors whatever you want. What I'm looking for is a stock, in this case it's Chipotle's, where weekly VWAP, if its weekly VWAP is trading above monthly VWAP, I will buy any pullbacks to that week. Does that make sense? It's think of it as a moving average, except it's actually where institutional activity is taking place. Oftentimes a moving average is just a line on a chart. This is where the action is taking place. So as long as that weekly VWAP level is above monthly, anytime it gets a little too far extended away from it, you just buy the next pullback down, and you can sit comfortably in that unless and until they just kind of cross. Does that make sense? It's a little, okay. But again, it's showing you what's actually going on in the market in terms of order flow and what the institutions are doing, okay? And it's just important to understand because that's what's driving prices. That's what's moving the market. That's what's offering support to the market. A lot of times you may look at it and say, oh, it looks like a moving average is doing this. Well, if the moving average happens to line up with VWAP, then yes. That's why sometimes they work, sometimes they don't. Okay. So on something like this with a small account, here's one of the biggest problems with a small account is that there are a lot of good moves out there on stocks, big stocks like Chipotle's. It's a $600 stock. Amazon, a $1,700 stock. But what's great about options is you can just do spreads where you can participate in the movement of these big stocks and yet not take a lot of risk. So for this particular one, we just sold a put credit spread for $4.25. We took it off this morning for $1.20. Okay, so it's not, it's one of those where, yeah, I'm selling it for $4, I'm buying back for $1, so on my 5 contracts I make $1,500. It's not as sexy as buying an option for $1 and selling it at 10, but that also doesn't happen very much. This is more about doing a high probability move that's going to cause your equity curve to continue going higher without large pullbacks, okay? Does anybody like large pullbacks that ruin their account? Yeah, they are fun, right? They make you feel alive and zestful.
It's time to sell premium.
Yeah, no, that's true. It's time to sell premium. It's interesting. It's like, my wife and I have been married over 20 years now, and it's funny because I don't think she still understands like what the market is or what I do. And there'll be times like at 8:20. Okay, I'm in Central Time, right? So 8:25 in the morning. Hey, honey, it doesn't look like you're busy because you're just looking at the computer and you're not doing anything. Do you mind making the kids breakfast?
Hey, it doesn't get any better in 50 years.
Yeah. Thank you for that. That's good. So I got her one of these T-shirts to see if she would just remember. It's like, so on times like that when she doesn't remember it, I just throw it to her and say, here you go. And then that way, because no words then come out of my mouth, which I may later regret. All right. So when weekly VWAP is above monthly VWAP, this is just a recap slide here, order flow is positive, so you can buy long calls and sell put credit spreads on pullbacks and vice versa. Dun, dun. She's texting me right now. She's like, I can hear you talking about me. But no, just kidding. So,
Can you just go back a second?
sure.
When your hedges are in the money, do you close them or roll them out?
Yeah, so good question. So when your hedges are in the money, do you close them or roll them out? So I tend to rotate so if we're just talking about the spider, so we're at the upper Bollinger Band, I'm buying puts. And if we come all the way down to the lower Bollinger Band like we did last week, I rotate out. So I actually get rid of my hedges, I sell my puts and just buy calls. So I just kind of, it's almost like rotating between the bands like that.
But then how do you maintain the hedge when you
Okay, good question. So the question is how do you maintain the hedge? So I'm not hedged all the time. Yeah, and generally, usually what happens is either I've got a specific signal like that where I want to hedge, or I generally like to have hedges on in the middle of the month, because that's when the weird stuff kind of happens too. Mm-hmm. Let's say that I've got like, say, 5 long positions on, I structure it so that they're not all market sensitive, right? So if I've got 5 long positions on, they're all market sensitive, well, I might as well just buy the spiders, right? So what I try to do is there's a phrase I like to buy, which are called honey badger stocks. So if you guys have looked on YouTube, you just type in honey badger don't care. Yeah, I mean, honey badgers are tough. They don't care what's coming at them. They'll fight lions. They just do whatever they want, regardless of the environment around them. And so what I like to do is find some stocks, not all of them, that don't care what the indexes are doing. So a stock like that might be Roku, okay, or right now Chipotle's, where you'll notice on down days these stocks are still kind of doing their own things. And so I like that because that's kind of a hedge that way too. So if I've got 5 or 6 longs, I want to have 2 that are what I call honey badgers, 2 that are directional market sensitive, and then I would call 2 like more spread related, income generation and things like that.
Will you screen that through the beta?
Yeah, so I do also, the other thing I use as a filter is I don't like to trade low beta stocks. So if I'm going to trade, so what beta is, if you got a beta of 1, that just means that the stock kind of mimics the S&P. Well, if a stock has a beta of 1, I would rather just trade the S&Ps because then I don't have to worry about any announcements, anything weird. And if it's lower than 1, like who cares? That's like kissing your sister. So the idea here with this is, I don't have a sister, so I actually don't know what that's like, but it doesn't sound exciting. But so the idea with this is that, now I just lost my train of thought. Yeah, okay. So the idea with this is if you can find a stock that has a beta of say 1.5, then okay, that's going to do 1.5 times better than the S&Ps. So I like to trade those high beta stocks. Okay, another thing with options trading, especially if you've got a small account and your goal is account growth and you don't really want a lot of potential devastation, is that you can structure your individual trades in a way so that if it moves against you, it's not a big deal. Here I am long Amazon, and you'll notice that Amazon is down $64. Okay, I bought this Amazon call debit spread the day before, and you can see it's only down $57 on the day. Okay, a whole key with this stuff is that what's really, it's just you can position your portfolio so you can still make steady money, but when you wake up in the morning, it's not going to be a nightmare if the market's doing or your stock is doing something that you didn't want. All right, if you've got these deep in the money Delta 70 calls on Amazon, and it happens to be the next morning there's bad news on them, you're going to get annihilated, especially if it's a big position in your account. However, you can structure, in this case, in the money call debit spreads, where if it goes against you, it really doesn't change the value of it all, and then if it happens to kind of close above it, you make, you position size it accordingly, but then you make it, about 30 or 40% on the debit spread. So that's a big part of this, is that a lot of times where people get messed up is they focus on how much money that they can make, when the reality of it is if you structure your portfolio so that you don't get your teeth kicked in, you can keep that rising equity curve. Yes?
I got a quick question. In lieu of Trump and the China trade situation going on, do you pick, let's say, Boeing and Caterpillar, which are pretty much, indicative of that trade agreement, which yay or nay? Are you keeping an eye on that? Are you doing like any, scenarios with coal and puts and that kind of thing?
Yep, so the question is that with the whole China trade deal, Boeing and Caterpillar are obviously 2 stocks that would be highly impacted that. Is there any good trades to do around that? So something like that is what I call kind of a binary event. And to reduce that, what I would do on something like that is rather than making a directional trade like, okay, I'm going to buy calls, and then you wake up something like with this morning on Boeing, whether it's a trade deal or a plane accident. With a straddle, you're buying either at the money call, at the money put, or strangle, out of the money call, out of the money put. And that way, it's like something's going to go down with this thing, and it just has to, if it explodes higher or explodes lower, you're good to go. And so on something like that, if it's a binary event that could really impact that quite a bit, I like to de-risk it a lot by just setting up the trade like that. So that way, I don't care which way it goes, as long as it goes. The other thing with option trades, which is kind of fun, and you can structure it, is that in this case, it's a put credit spread. You can set up like a put credit spread, but then buy a far out of the money put. So if you do get something like today, like with Boeing, that if it goes down far enough, it actually, this is your normal profit, but if it implodes, you actually could still make a profit too. And that's a nice little, because you can buy these cheap Delta 20 options where, it most likely is going to expire worthless. It doesn't really impact your trade, but if the stock implodes, it ends up being a good thing for you. And so I like that because, again, it's a way to get cheap insurance, and you're eliminating the possibility of waking up to a nightmare. You're like, oh, well, it sucks. I'm not going to make my max profit, but I'm still going to make a couple $100. That's way better than being down $5,000, okay?
What's the ratio?
So for every 10 lot spread, I would do 1 out of the money put. So you'll see that, there's going to be an area here where, and you could actually, bring it up more, but there's an area here where it's like, okay, there's a small zone of max risk. You could eliminate that too. I just kind of have it for those extreme moves, which are more newsworthy. Because generally, if something like this, I could get out if it's going to be a normal move. It's fighting those news events that can just wipe you out or wipe out that trade. The other thing here, and this is something that I don't hear a lot of people talk about it, but it's just rotating your exposure based on the time of the month. So there's probably some bad jokes in there somewhere. I'll be on vacation. So the idea here is that the first week, for the first 7 to 10 trading days of the month, I will generally be mostly exposed. Okay, I'm using I'm using up to 90% of my buying power. But once we hit about day 10 in the month, I generally am not going more than 50% exposed. Just because in the middle of the month is when you naturally get more weird shenanigans. You got monthly expiration, all those different kinds of things. So the trend kind of stops, and when you go back and you look at it, it's very, very consistent. If you go, you'll be amazed if you just kind of go back and start looking at the middle of the month. Just all this weird stuff happens, but then it ramps up again towards the end of the month. So what'll happen is, if you're kind of not aware of this, it's like you make money at the beginning of the month, you lose it all in the middle of the month, and then you try to make it back at the end. And it's a cycle that can repeat itself over and over and over again, and it's not fun. This way, it's like, use that beginning of the month to make your money. Middle of the month, pull back. You don't need to do a lot then. Just relax, do some spreads, and then at the end of the month, you can come back aggressive again. As an options trader, I'm going long calls in an uptrend and long puts in a downtrend for the first 10 days of the month. The middle 10 days of the month, I'm generally doing spreads, much more conservative stuff because I'm expecting chop, I'm expecting retracements. And then the last 10 days of the month, looking again for some bigger trends. So we had this huge rally today, and of course now we got kind of monthly expiration. My plan would be is I am looking for kind of a grind higher into this quadruple expiration on Friday, but I don't want any long exposure going into this weekend because I'm expecting a drop on Monday for the same kind of phenomena.
So your slide said 90%, 50%, 25%, but it's not in that order.
Yeah. So generally it's 90% invested the first 10 days of the month. Middle of the month, either flat or 25 to 50%, and then you get back to the last 10 days, going back to 90. Yes, thank you for the clarification.
50% mostly in spreads rather than.
Mostly in spreads. Correct. Okay. Okay, we talked about that. So another thing here is that, and I think where a lot of people can get lost on this too, is that we get really hung up on price targets. Okay, so you map out your trade. I'm buying Roku at 50. I think it's going to 58 because that's the 1618 extension or whatever it is. But what happens now is we've now kind of mentally forced an expectation in the future, and if it's not met, we'll be disappointed. I.e., if it gets to 57 and goes all the way back down to 40, we just watch it ride all the way down because it didn't hit 58. Has that ever happened to anybody? Yeah. If it hasn't happened to you, you just haven't been trading long enough. So to combat that, what I do is, in addition, again, in a small account, if you want to be a little bit more aggressive, I'll allocate 15% of my buying power towards one idea. Okay? Now, obviously, you can choose the risk that you want on that. But what will happen is if that position now suddenly represents 20% of my portfolio, I automatically sell a third of it, regardless of the target. Okay? Maybe it's not going to be at that 1618 level, but I don't care because I'm managing my net liquidating value. And what happens with this is that, sometimes you're going to get out of stuff too early, but there are so many times when you're scaling out, and you're de-risking your trade. There's that one day where it just comes down, and guess what? You're not in it anymore. So does that make sense? So as the position, if you start off with, and whatever parameters you want to do, but as my position starts off as 15% of my portfolio, and it jumps up to 20% because it's increased in value, I'm scaling out to make it back down to that 15%, right? So that if it does roll over and die, guess what? I've already taken some profits out of the trade, and it's not as big of a deal.
Where do you put the profits?
Where do I put the profits? Well, yeah, so stuff like that, it goes back to like if it's the middle of the month, I just leave it in cash until I see my next setup again. Does that make sense? Yeah. And and this is a good example too, and this is something where, especially if you're long options, weekly options are attractive, but for those of you that are, again, more familiar with options, you'll know that weekly options have very fast premium decay. So on this particular trade in data, I had one option, 73 days out, it was $12. When it reached 18, it went from, at this time, 15% of my portfolio to 20%. Even though I liked the stock, I only had one option, so I had to sell the whole thing, okay? And again, my price target was actually much higher. But the other thing I want to point out here is even though I only planned on being in this trade for 4 or 5 days, I went out 73 days just so I could minimize the premium decay. Okay, so even if I'm going to be, now, and you can do 30 days and that's fine, but if you've got a trade that you're going to be in even for 2 days and you're going to be long an option, do yourself a favor and go 30 days out. Yeah, is there exceptions to the rule? Yes. But what will happen is if you've got a short-term option and that thing just pulls back against you, it's got to recover not only back to the price of the underlying where you got in, but typically multiple points beyond that just so you can get back to break even, because of the premium decay, and you're not going to have that same problem with a longer dated option like that. So one of the things here, and I know that one of the biggest struggles people have is taking losses because it feels like a personal failure. So instead of thinking it like that, just think of yourself as a gardener, okay? If you're going to grow a really good rose bush, you've got to be a good pruner. What does that mean? You got to reduce the extent of something by removing, I can't say that word, superfluous or unwanted parts, targeted removal of diseased, damaged, dead, non-productive, structurally unsound, or otherwise unwanted tissue from crop and landscape plants. Apply that same description to your account. If you've got any trades that after 3 days are not working from you, they are stealing from you. Get rid of them. Don't try to nurse them back to health. Dump them and move on. And if you start taking that attitude towards your account, it's going to be a lot less emotional about, oh my God, it's a loss, and my dad was right, I'm never going to amount to anything. It has nothing to do with that, right? So just think of yourself as you're a gardener and you're just doing your job. And you got to remove those diseased positions from your account. Not only so your account can do well, but so mentally you can get rid of that and move on, because it's easy to get locked into that stuff. Last. So I do like to structure 10 to 15% of my trades is what I call low-risk Lottos. And what that means is it's a butterfly. It's a little bit more complicated, but I've got one of these on Amazon right now. This was one on Google, all right? So I bought this for 28 cents. And basically how a butterfly works is you sit there and you have a target. So in this case, my target on Google was 1,100. Instead of buying a deep in the money call for 30 bucks, I structured a butterfly. So you're buying the 1095 call, selling the $1,100 call, and buying the 1105, and in this case, it's just cost you 28 cents. The max profit on this trade is potentially $4,700. Okay, now the odds of that happening are pretty low. However, what happens a lot is you can buy these at 28 cents and sell them at 60 cents, or sell them at 70 cents, and once in a while, you get one of those home runs. Okay? And so those are kind of fun. If you don't know what butterflies are, you can Google it. But the main thing, just tying this all back together, about halfway through the presentation, I was talking about that monthly point of control. That's your target for your butterfly. Okay, go look at Amazon, go look at Google. Where's that monthly point of control? If we get too far below it, throw on a cheap butterfly up there. If it doesn't work, it's 28 cents. If it does work, it's a home run. So it's a really nice way to kind of balance out the risk with the potential reward. Question might be, well, Wash, if you think it's going to go back up there, why not just buy a deep in the money call? Because if it does go up there, you're going to make a lot of money. Yes, but remember, we're focused on controlling the risk, so we don't have to wake up and be frustrated with ourselves. And last but not least, don't be greedy. Again, this is Roku. It's been a fun stock to trade, and it's continuing to go higher. But once you get into, in this case, I bought these 5 options at 4. Here they are almost at 8. The percent that this now represents in my account this time is now over 20%, okay, and that's unacceptable. Even though I love the stock, I just went ahead and sold 3 more here, okay? If you do that relentlessly, what's going to happen is you're going to develop good habits, you're going to develop a good process, and doing this consistently is about adhering to a process, not trying to make money on each trade. Last but not least, one of the best things to use for what I call easy targets is just understand what the stock's average true range is. Okay, this is, again, it's an indicator, it's on any platform. If the average true range of the stock is $3, and then if it's up its average true range after like 2 days, great. Guess what? That is the low-hanging fruit target. And there's a lot of algos out there that start taking profits on that. So yes, it may go to the 1272 extension. It may go to the 1618 extension. I love those targets. I look at them. But in something like this, where your main goal is to grow that net liquidating value, just go for the easy money. Get that one ATR move, boom, get out next. Okay?
Not to interrupt,
But you are. But go ahead.
What type of range do you play for?
Who's asking? Oh, yeah, okay.
What type of range do you play for Roku? Because I looked at the chart, it's like, it looks like somebody's heartbeat, like that's smoking cigarettes.
Yeah, so on something like that, yeah, the nice thing about it though is when you look at the average true range, and I don't know what it is off the top of my head, but it's like, whatever it is, $3. So if you get your three ducks, if you get your $3, again, we're talking long calls here, right? It's different if it's a spread. But if you get your $3, get out and then just set up the next pullback. So that way, because it's like, yeah, this thing's crazy, but it's like, wow, when I'm looking at the average true range of the stock, which the algos are also looking at, and you just kind of play in that sandbox, then yeah, guess what? It may go up another $5 or $6, but you caught the easy move. So, yes?
You're talking about average true range per day.
Correct. Well, you can do average true range per day and per week. So I always look at the daily number, which may be 3, the weekly number may be 7, and so you can kind of look at both of those that way.
So which one do you use?
I use both. So.
There's a big difference between 3 and 7.
Well, so when we were talking about a position going from 15% to 20% of your portfolio, yeah, one ATR, boom, get rid of like half, and then see if you can get to that weekly level. Yeah. All right. So that was the honey badger. So let me show you guys this real quick. So I'm gonna stick back and answer questions, but if you guys want a copy of this presentation, you can go to this link. I think you just enter in your email, it'll get sent to you. If you just go to simplertrading.com/John, and at our site, Simpler Trading, we do text alerts. We send out the trades that I'm doing, we send out via text alerts. You can find information on the site, sign up for a free trial, and it's fun. I mean, we like trading. It's something that we find very enjoyable to do. And then otherwise, I'll stick around for questions. Thank you guys so much. Have a good rest of the show. Ta-da.